All right. Hi, everyone. Good morning. It's Monday, May 12th, and we've got some exciting movements in world trade today to talk about. We're going to cover the pharma industry. We're going to cover the US-China deal and what you might want to look at beyond the surface there, what we will be looking at over the next day or two, and how that will impact advisory of companies that don't import and export, right? What about companies that don't make products that are affected by other pieces of the market or other fallouts from questions and issues and movements like this. I'm Jenny Ray LaRue from Management Consultant. I'm here joined by Naman Mian, my colleague, and we are ready to dive in. Naman, you want to open us today?
Yeah, good morning, Jenny Ray. For those who thought it was going to be a sleepy Monday morning, surprise. There's big news here right before the markets open. We're excited to dive in. I don't think we should bury the headline. One of the things that we work with leadership teams on in our executive communication training is you never bury the headline unless you are delivering a stand-up comedy set. So that's not what we are doing this morning. So we're just going to lead with the headline, which is that the US and China have reached a 90-day reprieve on most of that escalatory tariff action that had been announced on Liberation Day. So, what does this actually mean? Because when you look at the surface, it looks like, oh, the trade war's over. And as much as I would like to say it's over, it's not, although this is an incredibly positive sign. So, what's actually happening is that tariff rates are coming back down to where they were, at the beginning of the Trump administration pre-Liberation Day. So the U.S. is keeping a baseline 10% tariff rate on Chinese imports. They are also keeping a 25% kind of fentanyl tax, if you will, right? A lot of the fentanyl that is coming over the southern border into the U.S. originates in China. And so one of the things that the Trump administration is trying to do is stop fentanyl at its source. And they're using or trying to use tariffs and trade as a tool to be able to do that. And so the fentanyl tariff is staying as well. And so what you're seeing is an effective tariff rate that was, 140% or more on Chinese imports coming down to 40%. And so are we still tariffing China? Yes. Are they still tariffing our imports coming over there? Yes. But much, much lower than what the rates were yesterday. And so I think it's important for people to know that this is positive news. We're moving in the right direction. The markets are going to rip in 10 minutes when they open. I think they're on pace. The futures contracts, as I'm looking at them right now, they're on pace to be up 3%. If that holds when the market opens, we would have clawed back all of the losses we've had since Liberation Day. And so, Jenny Ray, I'll turn things over to you. But one of my big lessons from this, beyond the fact that this is positive news, but not the whole ball game yet, is that for investors, if you stay invested, if you're a long-term investor and you stay invested and you don't let short-term events dictate your emotions, you'll end up winning in the long run. I was interviewed by CNBC just a few weeks ago after Liberation Day because I was one of the few people who was continuing to put money into the market. And what I told CNBC is what I'll say here, which is that if you have a long-term time horizon, then the best thing for you to do is not try to time the market, but maximize your time in the market. And so that's what I continue to do. And those who continue to do that after Liberation Day seem to be the winners, at least so far from an investing point. Over to you.
I'll just start with the punchline. I didn't do anything with the markets in the last month, not because I didn't believe that there was opportunity. In fact, I thought there was really significant opportunity in the market, but I moved my money outside of it largely in the last few years because I felt like there are increasing gains in non-liquid markets, and so I bought a company and I bought real estate in the last month, and so that was what I was focusing my efforts on because I saw significant returns with incredible upside and limited downside in non-liquid markets. So that was something that kind of was just a personal view of mine over the course of the last month. I want to talk a little bit about the US-China market. And Naman, I just want to start with a few questions. And I don't know that we'll have perspectives on all of these, but the questions that came up to me this morning felt more important to me than my insights. because I think a lot of people are going to focus today on the fact that it happened rather than the next questions that we should be asking. And so when I read the headlines this morning, right, I woke up on the West Coast and thought, well, goodness gracious, this is a big development. But what I immediately started to ask was, okay, how does this impact Microsoft? That was the first question I had, maybe not where everybody else's first mind goes. But Microsoft, who doesn't import, right, has relatively low and limited exposure to actual products in the marketplace. Um, how does it impact them, and why does it matter to a company like Microsoft? Because today we're going to see Microsoft shares likely increase. And I thought that that was kind of an interesting starting question. Do you want to start to kind of posit a response to that one? Because I thought it might be fun to just layer on a few of my questions this morning that I came up with. And I don't think it's important to have answers today. I just think it's important to start to think about what are the right questions for an understanding perspective.
Yeah, absolutely. Right. Like, how does tariff policy affect services businesses or affect
Mm.
businesses that don't necessarily import from China? So my initial reaction to that is when the broader economy is strong, Microsoft wins and services businesses win. So a big part of Microsoft's business is its enterprise customer. And a lot of those enterprise customers have exposure to either the Chinese market because they're trying to enter the Chinese market or because they're importing goods from China. So if they see a slowdown in their business, they are probably going to, right, carry some of that slowdown through to their operating expenses. And do I think that any Fortune 500 enterprise customer is going to cut Microsoft like out of its services stack? Like, no, I don't. But do I think that they'll slow down their investments in cloud? Perhaps. Do I think that they might slow down their investments in some of the other services that Microsoft provides, whether it's Copilot or whether it's some of the other offerings that they're trying to roll out to ensure that their enterprise customers stay sticky? Yes, I do think that you could see a slowdown in that kind of investment. So I think that Microsoft, Amazon, well, Amazon's got different exposure. We can talk about them. But
Totally, yeah.
right. So but kind of big tech services companies where you're like, wait, like you're not importing goods from China. Why does this matter to you? I think it matters to them because it matters to their customers.
And that was exactly where I went. I kind of thought, okay, if I were Microsoft, what am I managing to? No, probably my number one metric right now is butts and seats, right? Butts and seats. And so, like, if I have full employment, then I'm likely to have a pretty improving output. I'm interested in price increases. I have leverage over my customers. This is an essential service for many of them. And so that's kind of one of the core metrics, and different companies are going to have different metrics. So anyhow, that was immediately where my mind went, probably not where a lot of people's mind went. My second question was, who had leverage walking into the meeting to come out with a deal like this? Like, who got what they really wanted out of this deal? Because a lot of what we teach is that people, and we teach it less from a negotiation standpoint, although there's, I think, natural negotiation that happens in every business environment when you're just fighting for mind share. You're looking for making sure that your idea gets done, your project gets invested in. And so what we teach people is you walk into the room and you lay it out. This is what we want, and this is how we want to get it. And so the people that have both leverage and clear communication on that and have stuck to their guns are often the ones who, in the long run, win out. But my question was that, like, U.S. markets, U.S. investors are going to see a win from this today. If you were already in the market, you're looking pretty good. But how did we get there? What were some of the negotiation leverage points, and what would you have expected some of the things where that happened behind closed doors in that meeting?
That's a loaded question.
I know.
I'll just start by saying this. I don't think trade is a zero-sum game. So I think like the very reductive way to look at the news is to say, well, if there's a winner, there must be a loser. And that actually I don't think is real insight when you are like hearing people say that. I think that's a fundamental misunderstanding of how the global economy works. So I think in this particular case, everyone's a winner, and uh, the U.S. consumer is a winner because prices should come down from Chinese imports. Investors in U.S. equities are winners. Um, Chinese exporters and manufacturers are winners. And so, I think what this does, I'll call this a thaw in U.S. Chinese trade relations. I think what this thaw does is it gives us momentum to continue to grow the global economic pie. And if the whole pie grows, then everyone's slice is a little bit bigger. That's how I see trade. It's a way to grow the pie. It's not necessarily a way to get more of a fixed amount of pie. And so, when we can work collaboratively with China, which is the world's second largest economy, the US is obviously the world's largest economy. There are incredible ripple effects when you decouple the world's two largest economies. And so when there's any kind of collaboration taking place, I think the natural second order effects of that collaboration are the pie growing. And so what we need from our policymakers now is to ensure that number one, the pie actually grows. Number two, that our share of the pie grows in the ways that we want it to grow. And so I think in the past, what we've done as policymakers in the US is we've said, okay, globalization is a net positive, so let's just pursue this, no holds barred. And over the last 40 years, we've seen a lot of positives from that, but you've also seen them hollowing out of manufacturing communities in the US. And so what I'm hoping we see now is a more scalpel-like approach from US policymakers that says we can keep some of the positives of globalization, but let's see if we can keep some of the positives while mitigating some of the risks. And that's to me is the big question. Like, do we have smart, nuanced, patient, experienced enough people doing these deals and negotiating with China to be able to keep some of the positives of free trade while like mitigating the risks in the way that they need to be mitigated?
I think it's powerful. We looked at wine last week, Naman, and tried to identify, hey, like, do we think? And actually, somebody asked me at NBC, do we think that the share of U.S. manufacturing in wine bottles will increase because of this trade disruption? And I said, I don't know that that's our goal. It's not a hardcore input that we're trying to control. It's not a high value ad manufacturing type, and it's not a national security risk, right? So I don't know that we're trying to onshore everything in this kind of deal. We're actually trying to identify in some ways this was, I think, a poker move that tried to feel like we were flushing out somebody's hand, right? What were some of the things that we actually maybe knew, didn't know, and tried to identify that were not very clear for both of the sides of the negotiating table? And I think we took more of that approach in this deal particularly. One more thing about trade, and then I want to talk about pharma before we close. My next question, my last question that I want to talk about today was, does 90 days make a difference for actual decision makers and importers? A month ago, we had the expectation, well, let's call it a month and 5 days ago, right? Before Liberation Day, we had an expectation that there would be like maybe little bumps in trade. They would largely not impact whether or not people made trade decisions and purchasing decisions from China. It was largely expected initially to be only a pricing change, and a nominal one at that. Then you saw major changes that actually didn't just affect pricing, but actual purchasing decisions. Should I buy that thing at all? Should I continue to bring it in? And that was part of the conversation for me in wine that led to an interesting deal, which was like, we stopped buying bottles. We have them on their way. Once these arrive, that's it for us. And so, is 90 days enough to actually affect the decision makers in a now uncertain market, right? Because they've always bought with certainty since these modern day trade deals have been established. We have continued uncertainty. Even today marks kind of a radical swing in the there's no new normal, is what this is identifying to me. I think we're still going to see a pause in some of these imports. I think we're still going to see cautionary price increases as a hedge against those. Curious if you see some of these after effects as well.
I do. So I think this is incredibly industry and company specific, right? And scale really matters when it comes to imports and exports. And maybe we should break that down on a future episode.
Sure.
But generally speaking, I think here's what I'd be doing. Number one, long term, nothing changes for me as a decision maker inside of a business that's affected. I'm looking to like reorient my supply chain around China because I don't think that fundamentally like anything has changed vis-a-vis like the US's commitment to ensuring that we reduce a trade deficit with China. Like that commitment hasn't changed even after today's news. So I'm looking to move to Southeast Asia. I'm looking to move to India. I'm looking to come back maybe even to Mexico, Canada, or hopefully the US. So like long term, my plans haven't changed. I think what this has done is it's bought me some breathing room. So what I'd be doing right now is I'd be using this news as leverage to actually get better rates from manufacturers in other countries. And I'd be trying to convince them that, look, things are going to go back to normal with China. And that point you made about leverage is critical here because what manufacturers in Vietnam or India have been able to do to some of these large companies is hold them over a barrel and say, look, there's no other game in town now. And so they've been able to extract concessions. They've been able to raise prices. They've been able to give lead times that make sense for them. I'd be going back to them and saying, look, I'm ready to go back to China unless you want to play ball with me. So I'd be using this news as leverage, number one, for some of those other manufacturers. And then number two, I would be increasing my rate of imports in the near term from China. And I'd be trying to, as much as is possible, based on my balance sheet and based on my cash flow situation, hold inventory in the US so that I could hold the line on price increases as long as possible, because I think that's going to be a competitive advantage for a lot of these businesses. And for the ones who have strong balance sheets, this is an opportunity to take market share. Because the longer you can hold out on raising prices, I think the more share you're going to be able to take. And I think the smart companies who have been managed well will be able to actually use the disruption as an opportunity for market share growth because they're going to be able to keep their prices lower for longer.
The last thing I think we should talk about today is just the pharma news from yesterday and this morning that the U.S. plans to significantly ditch some of the price. I would call them price buffers, right? That the pharma industry has largely charged the U.S. in the past on Medicare, Medicaid, and places that the U.S. has total leverage, right? We're not a complete government-run healthcare market, so this only impacts portions of the healthcare spend. But it is pretty significant news for pharma leaders today. Can you just talk about, in the pharma space, some of the leaders that are probably thinking a little differently this morning about some of their future and what they would do in this kind of situation? I had an immediate thought, so I want to get your hot take first before I land with mine.
Yeah, January, I don't have a hot take. I think this is one of those topics where I think it's smarter to ask questions, right? Similar to your take on trade. I'll just say this, like at surface level, the US government seems to me to be the largest procurer of pharmaceutical drugs, in the world. And so it makes sense to me that you would use that scale to extract price concessions. Like on the surface, that makes sense to me. My one question and potential concern is how this affects the R&D landscape in US pharma. And that's the question that a lot of our clients are asking because we work with a lot of large pharmas and leadership teams inside of those companies. And I think the concern is, look, one of the things that sets the US pharmaceutical market apart is the fact that we get access to cutting edge drugs faster here because of the velocity of R&D that we're able to undertake here. And so when you implement, what they would call, I think, price controls, what you're saying is there's less money to funnel back into R&D, and that could be a problem. Now, is that going to be their spin because they want to protect their business? Absolutely. Right. So I think there's a lot of noise to sift through here, but I'll say on the surface, it makes sense to me to flex your kind of your purchasing power here as the largest, purchaser of these kinds of drugs and services. But there might be second order effects that are a little bit unintended if we end up moving forward. What's your hot take?
My hot take. I'll lead with a question and then I'll kind of land with the hot take. So my immediate question was, how many of the drugs that we sell are protected by patent law, are actually in competitive markets in other places? Because actually, what the U.S. has in some cases done has been use willingness to pay inside the U.S. to subsidize drug access in other nations, and I think that's a large piece of this rebalancing. Is like, hey, that's probably not appropriate or fair to have the U.S. be a subsidizer of drug access in other places. And I think from a policymaker's decision, that's a very clear standpoint. from pharma, what I would be thinking about doing is, am I just selling fewer drugs or am I repricing? So if a share of my price pie comes down inside the US and I'm not largely looking to expand what I sell, then I'm probably going to look to rebalance pricing in other places. How much power do I have to do that? That was kind of my first question, right? How many of my drugs are sold in competitive markets? How many of them are protected by patents? And how many of them are kind of in an R&D protected space at the moment versus kind of a more pure economic play. Yeah, so my overall hot take was that I think that pharma companies are less, are while exposed in large part to the U.S. price market, that they have a strong position in terms of what they do, and I expect that we will see both. Advances in R&D increasing the kind of rapid nature of our ability to do R&D advancing in the future that will be commensurate with some of these price contractions. And I also expect to see a boon in private market access. So I don't think that we're going to have lower amounts of drugs or lower kind of numbers of drugs. I think that the US will get what it's looking for in the government funded sectors, but I think that in large part the thing that many people care about, as you already mentioned, is access to the drugs that are life-saving or issue driven for them, not the actual prices that are being paid, and they will
Mhm.
pursue alternative courses to get that, and therefore to kind of in an ancillary way fund R&D. So I think that there is less downside for pharma than we're going to see in the trading
Mhm.
today.
One last thought that I'll just share here, Jenny Ray, is I think the mindset of the US government is right, which is, same thing when you look at some of the consulting contracts that they're renegotiating. It's like we are the largest purchaser of services in this space. Why are we getting less favorable terms? Right?
Like
Like there,
market or worse than market terms.
yeah, like,
Exactly.
like like there should be benefits that come with the volume that we're purchasing, whether it's consulting services, whether it's drugs, whether it's something else. And that to me is a very common sense approach to procurement. Are there potential unintended consequences? Yes. Do you have to be careful about how you execute? Yes. But I think the mindset is the right one and one that US taxpayers should overall be very happy with.
I agree. Well, thanks, Simon. It's been an invigorating conversation. We've run a little long today, I think, with merit, right? I think there's a reason that we did that. But there will certainly be impacts of this news and of inflation news reported later this week, which I'm really excited to see. I think that that's kind of a unsung hero in this kind of overall metrics between the markets and the economy that we're going to see some real impacts from this week. So it'll be probably occluded by this China-US deal, but I still think it's incredibly important. I can't wait to tease it out with you. So I'll
And
see
I
you.
think,
Oh yeah, go ahead, Devon.
yeah, we'll see you tomorrow morning. I was just going to say Jerome Powell vindicated for not cutting rates last week. So I think the wait and see approach ended up serving the Fed really well.
Agreed. Can't wait to talk about it more. We'll see y'all tomorrow.